All right, guys, what's going on here? Eric here from Traveling Trading. So I wanted to make this little quick video slash little presentation thing for a lot of you guys, especially you new people, because you guys, are just now stepping into the market for whatever reason, one way or another, whether it be to make extra money or just interested in the stock market, whatever it is. You're here now. um, and a lot of you new guys are, always kind of asking, little questions such as like, what's this mean? What's that mean? Things like that. So I figured I'd make this quick video here to kind of go through some basic stuff that you should know when starting out. I noticed that a lot of the things that are out there on YouTube and whatnot, kind of just leading you guys in circles, and you kind of don't know where to begin. So this right here is going to be a basic 101 stock trading, getting started, thing for you to be able to start to understand the ins and outs of this world. As I go through this, presentation, I'll mention what things are relevant to what you need to know and what you don't, but it's still good to know kind of thing. So without further ado, we'll get this started. There'll be more stuff coming. Apparently, a lot of people are asking for stuff like this, especially in the chat room. So I'll start putting out more things like this to help you guys out, especially for you new people. The app itself that I was talking about will also be able to be downloaded in the chat room that I'll send to you guys. So I know a lot of you are busy on the go. You can't be sitting in a computer screen all day and everything, which is perfectly understandable, but it's still a lot of stuff to study and understand. So that app is going to help you to be able to do all that stuff on the go, and kind of test your knowledge and make sure you're actually understanding what's going on with these things to help you become a much better trader. Throughout the course of time. Okay. So I like to get straight to things. I don't want to beat around the bush. I don't have nothing here to promote. Just want to get straight to it so you guys can understand the stuff, and start trading and start making money because that's what we're all here to do, right? So let's get this bad boy started. All right. So first and foremost, let's take a look at this disclaimer here. Obviously, this is just kind of mentioning that I am not a financial advisor or this is not legal advice. Basically, take this with a grain of salt. It's for entertainment and purposes only. I am not liable for any of your losses or profits if, throughout your stock trading career or anything pertaining to that matter, blah, blah, blah. Anyways, take your time and read this whenever you get a chance. Basically, it's saying I'm not liable for anything that you do. So you guys can take a look at that, okay? All right, so let's get this bad boy started. I want to just kind of briefly touch over for you new guys what it's going to take here to succeed, because at this point, if you don't know or you think you know and don't have, and have some kind of idea, but it's actually something different, you're going to find out now. And that way it'll save you some time and have to, waste your time doing this and seeing if it's a good fit for you or not, okay? So basically, this is a little bit of things that I've realized that people need in order to see when it comes to stock trading. Number one, of course, is going to need knowledge. You need to know what you're doing. There's no way you can just jump into doing this and think you're going to make thousands and millions of dollars without knowing what you're doing. You might get lucky, but it won't last long. So knowledge is definitely something that you're going to need to have, all right? And that's what we're going to get our foot wet, or let's say our toes wet today with, to get you going, because there's definitely a lot of knowledge out there when it comes to this thing. The next thing I think you kind of need, in my opinion, is a slight obsession. You got to be kind of obsessed with the stock market, at least have some type of interest in it, for more than the purpose of just making money. Whether it be like to want to understand the business world, see how things work in the financial sectors, or whatever it might be. You got to have some kind of interest in it, because if you don't, you're going to get bored because this stuff is kind of boring and you're just going to quit. So if you're not even remotely interested in anything about finances, stock market, things like that, aside from the fact of making money, you might as well probably just go do something else that'll probably help you make a lot of money, because this won't last long and you definitely won't be, into it as much as you should be. So that's just my opinion right there. The next thing you definitely need is some good tools. You got to have good brokers. You want to definitely have good scanners, and you want to have a good community, things like that. You want to have tools that are going to be able to allow you to do what you need to do efficiently and effectively. I can't tell you how many times I've, tried a different tool or tried something that's worked out better than another, and it's definitely, improved my trading tenfold sometimes, depending on what it is. And every person is different, so it's a good idea to get your feet with a little bit of things here and there to see how it fits for you. Even having a community in a chat room definitely is something that's beneficial. I thought it wasn't at first. I thought, hey, I didn't, I'm not going to need a chat room, blah, blah, blah. But no, that stuff helps more than you can think of. So that's, little things like that are good tools to have for you as a trader. Okay. The next thing you want to definitely have is the ability to be adaptable. All the traders that I know that have lasted long in this game have been able to adapt their trading style as time progresses. You never want to be stuck into one thing because the market is always changing, and so do you. You want to be able to grow, evolve, and be able to, switch up your game whenever you need to. Okay, so that's something you want to definitely be able to do is be adaptable. The next thing you need to do is have some emotional control. You'll hear a lot of traders talk about this emotional control. At first I understood it. Well, let me rephrase that. First, I got it. I know what they were talking about, but I never really fully comprehended or felt the effects until started actually trading and started reviewing things of how you trade, because there's a lot of psychological and emotional control that's needed. You need to be okay with losing. You're not going to win every single trade. That's why risk management is important. You got to be patient. The stock market isn't jumping every single minute of the day. Um, and even if it is, it might not be something that you need to jump into. And then there's discipline. You got to be be able to stick to your rules. That's what you have a strategy for. So you got to be able to keep with having emotional, psychological control, and that might develop over time. You might not have that right away. As you're trading more and more often, you'll start to develop that and be able to practice that as well too. Trust me, it took me months. Sometimes I still have trouble with that. I've been doing this for years. I know many traders who do. So that's something you definitely want to have to be successful. And of course, the last but not least is something that nobody can teach you. I don't care how many videos you watch on stock market. I don't care how many books you read on the stock market. This is something that no one is going to be able to give you, and that's experience. Only you can give that to yourself. Um, like Warren Buffett said, time in the market is definitely more important than time in the market because the experience is what's going to ultimately teach you how to be a good trader, for better or for worse. So that's definitely something you need to be successful, and that will come over time. But that's pretty much what you need. If you're okay with, having this stuff, go on to the next slide. If not, cut this thing off, go do something else, start looking for a side hustle because this isn't going to work for you. All right. So let's move on. Now, again, like I said, I'm going to treat you guys like your little kids, little babies, and break this stuff down for you because these are things that you're going to need to know. You may know a lot of this stuff, especially if you've traded before or maybe took some finance classes or things like that. You might know most of this stuff. But if not, if you're brand new to the stock market, have no idea what's going on with anything, you need to pay attention. Okay, so I'm gonna try to go through this as quickly as possible, but this will be a good reference point for you guys, and from there on you can start looking and googling and searching different things that you might be interested in pertaining to it. Okay, but we'll talk about which ones might apply to you when it comes to stock trading. So first and foremost, we'll talk about investment types. First ones, of course, there's commodities, physical substances like oil, gold, grain, and things like that, excuse me, that can influence the market. So those, there's commodity traders that specialize in trading that stuff as well too. Then there's derivatives, which is, futures and options tradings that derive value from other investments like stocks. Not every stocks have the ability to be traded, as an option. You'll hear people talk about calls and puts sometimes. It's kind of relevant to stock trading, but on a more advanced level because you're dealing with, delta, gamma, and theta and things like that. Things that are out of your realm right now for a beginner. You can look at that in your own time afterwards. I'll probably do something about options later on, but right now, just know it affects you, but not too much to a certain extent. Okay, but that's what derivatives are, a different investment type. Then there's real estate, physical properties. Those rarely influence stock unless you have like a real estate investment trust or what they call a REIT. Might be an exception there, but other than that, it's not really going to affect stocks too much. Then of course there's stocks, which is basically pieces of paper that says you own a percentage of a company. Okay, pretty simple. Those are just different investment types. So we're going to focus on what we're focusing on here, which is stocks. Now, what is a stock? Of course, a stock is, when a company, needs offers shares to raise capital for operations. They sell a percentage of the company, ownership stake in the company, and it's based on supply and demand. Okay. Now, the stock price is basically where the buyers and sellers come together to price and swap shares. That's where the stock price comes from. Pretty simple. You should know that. Some more stock terms here. There are investors, and investors are basically a person or entity, like a fund or a firm that commits capital with the expectation of receiving other financial returns for a profit. mostly. So yeah, that's what an investor is, someone who takes on that risk, or a company that takes on that risk. Then there's stock traders. Okay, traders are people who trade equity securities. Their primary goal is to purchase and sell shares in, from different companies and try to profit, whether it be short-term or long-term gains from them, as the price fluctuates for them and their clients. Pretty simple. That's what a stock trader is. That's what you are. Then there's fundamentals. So fundamentals is basically judging the stock based on the actual company's business and the financial statements of the company's mission, profits, losses, earnings, revenues, things like that. Just evaluate how good a company might be doing. You'll see that in the video that I posted. I posted a video about how to do fundamental investing, the way that I do it. So that's a good video there. You can kind of check out on how to, look at fundamentals and read profit and loss statements and revenue and things like that. Okay. So that's pretty simple. As a trader, you're not really going to need that no much. If you're a day trader, you're not really going to need fundamentals that much. Really, will you ever? Because you're trading off of technicals. But that's still something good to know. I usually look at fundamentals when it comes to long-term investing, like stocks I might want to hold for a while. So, or companies that I want to invest in long term. But that's pretty much when you would use fundamentals. Now, technicals. Technicals is what we are going to be focused on here as traders, people who get in and out of stock in the day in and day out. Basically, that's just judging the stock based on price action, chart patterns, and things like that, different indicators, and we use it for trading purposes. Rarely do we use technical analysis. Technical trading or technical analysis isn't barely used for fundamental long-term investors. They don't really care about that stuff. So those are just a brief little terminology there for that. Okay. Now, another thing you guys need to know, basically, are who else is in the stock market with you. That's one of the things that is very key that people forget to they underestimate, is that you're not the only person trading stocks. Okay, so you need to know not only what you're playing, but who you're playing with. Okay, now let's first start off with the amateurs. These are you. These are new people who are new to the market, don't know what's going on, bright-eyed, bushy-tailed people who are probably going to get their accounts blown up because they have no idea what they're doing. Hopefully, what I'm showing you guys and what you're learning is going to help you be able to not be one of those. Okay, but those are the people that are in the market as well too, amateurs. And every day a sucker's born, unfortunately. So hopefully you're not one of them. But those are some of the players that are coming into the market, and we'll talk about their tendencies and the psychology under that when we do some more videos about trading and different things as we go along. Okay. Then there's independent, proprietary, and retail traders, which are traders like me, myself, and the other popular traders you might know that trade day in and day out with either our personal capital or leverage. The retail traders, that's who we are. Pretty much people that are like Robinhood, investors, or people that are using, Webull and other brokers and things like that are considered retail traders. I mean, a lot of them are also amateurs, but they're also retail traders as well too. Okay. Now, market makers, those are professional security dealers. They definitely influence stocks and they execute orders on behalf of, the brokerage firms, that you might sign up with. So basically, a market maker, let's say if you had, Robinhood and you placed an order, with Robinhood, Robinhood sends that order to places, that to the firm that has the market makers that executes that order to them. So those are pretty much market makers. Okay. Then there's institutional traders. These are large firms, the big smart guys, the big brains, the Harvards, Yales, and all those smart people that are trading large money on behalf of whoever, their clients. So those are institutional traders, the big whales. Okay, you'll hear that term a lot as well. All right. So then there's the SEC. The SEC is the Security and Exchange Commission. They're basically the governmental entity that influences the whole financial sector for the public. You'll hear a lot of things about the SEC for one way or another. Not going to put my input on that, but just know that who the SEC is. They basically watching over all the market and the governmental body that influences that as well too. Okay, so you'll hear about them every now and then. Now, other investors, there's also concept investors. Now, these guys, they look for long-term potential investors. That's pretty much what they are. They invest in different concepts. Distressed investors, those are investors who like to buy small companies and think that they can, probably turn them around companies that have been suffering. They look for beat down companies and come up with ideas to be able to probably turn it into a profit. So those are distressed investors. Then there's value investors, like I mentioned before. They look for long-term, solid fundamentals for a company to invest in that they see is going to be able to, provide them some value, whether it be growth or dividends. Those are value investors. And then there's the growth investors. They look at fast-growing companies with a lot of price momentum. Um, you know, just different type of companies out there that are like that. You don't really need to know any of that. You're not going to be any of those investors because you're not going to be an investor. Period. You're a trader. I mean, if you want to invest, look into doing that on your own time. All right. Then there are the fundamental terms. So if you're a fundamental investor, like I said, you're looking to invest long term in the company, you believe in the company, think it's solid, and you want to check it out. These are some terms you definitely want to know about that company. Again, you'll be able to see the video I posted about it, but we'll talk about those terms real quick here because you usually hear this mentioned throughout like news articles that might circulate about a company, press releases, and things like that. Okay. Profit and loss basically summarize the revenues and expenses from a company. The revenue, of course, is the money that's generated from the business operations. Expenses is the costs that require them to do something. The asset is something that has useful value within that company. Liability is the company's financial obligation that they have to pay something. Okay. Now, earnings per share is basically the stock price divided by the market cap. Pretty simple there. I didn't finish that part, but we're good there. Then there's cash flow. The cash flow is basically the net amount of cash and cash equivalents that's being transferred in and out of the business. Pretty simple there. Cash flow is a big thing that a lot of investors look at too. And then the PEG basically is the price earnings to growth. That's another thing that a lot of fundamental investors will look at as well too. Okay. But again, fundamental terms you don't need to worry about. You're trading in and out of the market, and you don't really have to worry about that until you're looking at long-term companies to keep. Okay. Up next here is technical terms. These are some technical terms that you'll be hearing a lot from different traders and their trading styles and things like that. There's plenty of more, plenty of more. I'm going to actually have to do a whole section on this, but I'm just going to touch on a few for us here real quick. There's moving averages. This is the price of the stock over various different time periods. You'll see there's different moving average indicators everywhere that are there. So we'll talk about that later. There's support. Now, support is the area where a lot of buyers are looking to buy a stock at a certain price point. Then there's resistance, and this is where sellers are looking to sell their orders at a certain price point. So a lot of people that look over charts are looking at things like support and resistance. Okay, so you need to know that a lot of other traders are usually looking at support and resistance lines to kind of determine what they're going to do in their strategy. All right. Now, a breakout or a breakdown, you might hear that, and that's when a stock starts to break out through the resistance to the upside or break down to support to the downside. Okay. So if a stock breaks out, that means once it's hit a resistance level where a lot of sellers are at, and it's broken through that, filled all those orders, that means it's going up. It's broken. It broke out past that resistance level. Opposite way as well, it's breaking down. If support orders get filled at a certain price and it keeps going lower, that means it broke the stock price and the stock itself broke down. So you'll hear that a lot too. Now there's volume, and that is the number of shares being traded. Pretty simple there. Then there's VWAP, which is the volume weighted price average. I'm sorry, volume weighted average price. I should have switched that around. This is like a benchmark that a lot of traders use. It gives you the average price of the stock security over time. It's a pretty good indicator that a lot of traders use because of the price and price action tends to go towards to that VWAP level. You'll hear more talks about that. Now, the trend or the market trend, this is basically the perceived direction of the market over a certain period of time. You'll see traders say, okay, look, you can see that the stock is trending upwards or it's trending downwards. That's what a trend is, the direction of which the stock is moving. I probably should have put some trending stock for you right there to kind of give you an idea, but that's pretty much what it is. You hear us talk about that a lot too. Studies is basically it's a stock analyst tool. Now that's used to kind of help determine the future activity or price point of a instrument in a stock or sector or market. So basically, a study is going to be any type of tool or indicator. It could be and I'll talk about this some more. It'll be things like the VWAP, the RSI, moving average indicators. There's a whole bunch of different studies analysis tools that you can use. But when you hear someone says, okay, what study are you using? They're asking, what kind of tool or, what kind of indicators and isolators you're using to be able to, do your trades. So pretty easy, technical terms. Get used to those because you're going to hear those a lot. All right. More terminology. You have buys and sells orders. So buys are basically where a buy is where shares are hoping to rise. Sellers are, sells shares hoping that it heads lower. You'll hear that a lot too. Okay. Now, short selling, basically, this is where the stock is going to be headed lower. You never want to own shares that you're borrowing. Okay, so you don't really own those when you're short selling. You're basically borrowing those shares, if that makes sense, because you're expecting the stock to head lower and you want to buy to cover, which is the next one, which is buying to cover. Is basically when you have a short position, you buying to cover. You're basically buying your shares back that you sold short. So let's say, for example, if there's a stock for $10, it's trading at $10. You think the stock is going to be, worth $4, right? So you're short selling that stock. You're borrowing shares in hopes that price goes down to that $4. Buying to cover is when the stock hits that price, you're buying the borrowed shares back from your broker and you keep the difference. That's when you're buying to cover. Okay, pretty simple. You'll see, you hear short sellers every now and then. I've short sold a few stocks. I don't like doing it too much. I'm more of a bullish trader. But every now and then when I need to or I see a pattern, I'm like, oh yeah, that needs to be shorted. And if the shares are available, I'll do so. Then there's a no position, which is a cash position. Basically, you're not in any stock. You're just sitting there, sitting your hands, twiddling your thumbs. Get used to that. You might be doing that a lot too. All right, so that's pretty much what a no position is a cash position. Now, margin. Margin is when you're using money from a broker to trade stocks. You don't have the money in your account, but you're using it to trade. Okay, so that's what margin is. I encourage you as a new trader, don't use a margin account. You need to be using a cash account if you can with your broker. Margin, you probably want to stay away from because you don't want to end up owing money that you can't pay back. All right. Then there is short squeeze. Now, short squeeze is what happens when short sellers try to avoid losses by covering their positions quickly, moving the stock price higher. So with short squeeze, you guys probably seen this recently with this GameStop stuff that's going on, is when a bunch of people are going to buy a stock or a bunch of orders for buying a stock go through and the stock price shoots up. These sellers that are short selling it, expecting to go down, see that it's going up, they got to cover their positions. So they're going to have to cut their losses and buy the cover and take that loss that they have. Now, this will typically happen a lot if there's a lot of short positions there, or even if it's small short positions there. They got to cover their positions, and this can cause the stock to shoot up pretty quickly. So that's called a short squeeze, squeezing those short positions to where they have to cover. And things like GameStop, kind of happen every now and then, especially with small cap stocks. Okay. Now, hard to borrow. Those are just stocks that are difficult to find shares to borrow from to short sell. Not all stocks always have availability to short sells. So, that's basically when you're here, hard to borrow stock, what a hard to borrow stock is, one that's going to be hard to sell short. Pre-borrows is basically reserving shares ahead of time for a company to short. It's very important, especially if you're, dealing with companies that you think are crap. Okay, so being able to pre-borrow is definitely a good thing. You can check with your broker to see if you're able to do that. Some of them allow you to, some of them don't. Every broker has different requirements, so that's something good to always check on if you plan on being a short seller. If that fits your personality. Then there's the SSR. That's a short selling restriction. Basically, when you're restricted from selling shares in a company, typically that happens when a stock might have shot up in a certain time frame. A certain percentage. If it's gone up, then you're not going to be able to short sell it. Some brokers have restrictions on that, or if it's been down too much, you're not able to short it as well too. So it varies from broker to broker. Just check with your brokers on that. Pretty simple there. The next thing you guys would want to know is your market hours. All right, and markets. Now your brokers. So the broker is the person or entity that buys and sells the stocks in the direction of their client. So your brokers would be example like, there's basically everyone's doing online discount brokers. Then there's full service brokers as well too. So there's like Webull, Robinhood, Moomoo, E-Trade, Fidelity, Charles Schwab, Interactive Brokers. I mean, Capital Market Elites Group, Speed Trader. I mean, there's so many of them. Basically, those are your brokers. They execute the orders that you place to buy or sell a stock. Pretty easy. Every broker is different as well too. You definitely want to know what your trading hours are with your broker and what options you have with them. Not every broker is the same. Some of them will allow you to buy certain stocks, like full service brokers will let you buy like penny stocks and things like that. But online brokers like Webull or Robinhood won't have penny stocks on there. Every broker is different. So definitely make sure you're looking at your brokers and making sure they're fitting, and their times might be different as well too. You might not be able to trade certain hours that you can on certain brokers. So that's something to keep in mind as well too. We already went over what market makers are. Like I said, they are the ones that provide the liquidity for the company to be able to execute the orders that they have, and they make their money based on the bid and the ask spread or turn, depending on what you're doing. So that's pretty much what the market makers are. Now your pre-market, that is your pre-market hours are from 4 a.m. To 9:30 a.m. and these are Eastern time frame, Eastern Standard Time. Okay. Then you have regular hours, which is 9:30 a.m. to 4 p.m. Then you have power hour. You'll hear that mentioned to people. That's like the final hour of the regular hours. So pretty much from 3 to 4 is power hour, where stocks are making moves before the end of the day. And then there's your after hours, which is between 4 p.m. to 8 p.m. Eastern. Okay, stocks are still moving, just not as much. Now, pre-market and after hours are really, really slow times. You'll see that you're only able to make certain types of orders, like limit orders. You can't do market orders, and we'll get into that here in a second. But it's a lot less transactions going on. Still movement in the stocks, but it's just kind of limited. It's not as much as it is opening bell, regular market hours, or power hour. Okay, pretty simple there. All right, what is a limit order? We're going to go over these orders here real quick. A limit order is basically an order made to trade a stock at a certain price point that's specified by the person that placed the order. So if you say, I want to buy this stock at $3.50, until that stock hits $3.50, your order will not get executed. Okay, pretty simple there. Or at that point or better. So let's say, for example, the stock is at $4 right now. You wanted to get it at 350. You put in that order for 350, a limit order for 350. Until that stock hits 350, you're not going to get filled. But let's say if you like, I still want it for 350, but the stock is trading at $2.80, you'll probably get filled right away because you're getting it better. You're getting it at a better price. The system automatically knows to do that. So that's what a limit order is. Pretty easy. Now, limit orders can be placed pretty much throughout the whole time frame, whether it's after hours, pre-market, doesn't matter. Regular hours, you can always place a limit order. And in after hours and pre-market, you can only do limit orders. You can't do market orders, and we'll cover what market orders is in a second. A stop loss order, that's basically an order placed to liquidate, whether either sell your shares if you're bullish or buy the cover if you're short selling a position once the stock has passed a certain price point or percentage. It is used to protect gains and prevent losses. If you're a new trader, stop loss is good. The problem is with these things, they don't always get executed. Sometimes they always do because market makers are trying to take them out. I use a mental stop loss. I don't place stop loss orders so much unless I have to. If I'm out and about and something's happening and I gotta go, then I might place a stop loss order, especially if I'm in the green at the time. But yeah, that's what a stop loss order is. It's very handy if you're always on the go. I encourage you as a new trader to do it. I wish I would have used it a lot more when I was starting out, especially because if you don't have like a lot of emotional control, it's a good tool. Good tool to have. So play around with that a little bit when you can. Then there's a trailing stop loss order. Same thing. It's a moving stop loss order. Basically adjusts as the stock price changes. It's kind of a more advanced stop loss order, so definitely use it if you can. It's definitely a good one to have. It moves as the stock moves. And the type of stocks we deal with, especially in the chat room and alerts, these stocks move quickly. So definitely something good to use. Now there's market orders. Market orders are, placed to be able to trade a stock at the current market price. I don't recommend using it for a few reasons. Well, I mean, you can use it. The reason why is because 9 times out of 10, when you do a market order, they're going to probably fill you at the worst possible position. you know, you're basically just saying at that point, I don't care what the price is, just give me some shares, give me some shares, and it could be a ridiculous price, especially if the price moves pretty quickly. And now, you're feeling, you're hoping to get in at 10, maybe $11, but the stock then jumped up to $16, and they fill your order at $16, and you got a big difference there. So that's what a market order is. But that's just when you're desperate, just want to get in, you see the thing is running away, then, maybe at that point you might want to do it. But for the most part, don't really recommend it. But it's up to you. You might be a trader that can do it. I know a lot of scalpers use it, but that's them. So there's that. Then there's the day GTC order, which is basically good to cancel order. Sometimes they last 90 days. This is you placing an order at a certain for a certain security, whether it be a stock or whatever, at a certain price, hoping that it gets there within the next 90 days or until you cancel it. Normally, doing a limit order or like a market order, if you place that order with your broker, by the end of the day, if it's not executed, they're going to get rid of the order and start everything over from scratch. But if you do a good to cancel order, that order will last for the next 90 days or so, or until you cancel it, or until it gets full, until it gets filled, whichever happens first. Okay. So then there's pre-market orders. These are orders that are set during the pre-market time. Again, they only get filled. Limit orders in pre-market. Same thing for after hours, which is placed during after hours time. And you'll see that on the previous slide what those time frames are. Then there's the bid and the ask. The bid is the highest price that someone is willing to pay for a stock. And then the ask is the lowest price a person is willing to sell that stock. The spread is the difference between the two. Okay. And then let me jump on real quick here what uptick and downtick is. The uptick is just the stock going in a higher direction. Downtick is it going in a lower direction than the previous trade. So let's take a look at this picture that I have here of OCGN. You'll see here that the bid right now is 1020. The spread here is 1040. I'm sorry, the ask here is 1040. So the highest someone is willing to bid for this right now here is $10.20. The lowest someone is willing to sell it is $10.40. So there's a 20-cent spread right there on that bid and that ask price. Okay. Hopefully that makes sense to you. This is actually recent too, so you'll see this a lot of times in the level 2 of the orders that you're placing. Pretty simple there. All right. More stock terms. All right. Volatility. Basically, how sharply and quickly a price might change. Momentum causes great swing prices, and the swings will eventually reverse. Volatility is very important, guys, especially for the stock that we're trading in alerts in the chat rooms. The ones that we trade, we hope are very volatile because the prices change quickly. You get in and you get out. Some of the stocks we deal with are very volatile. Or you hear people say things like Bitcoin and things like that are very volatile. Basically means that the price changes exponentially. It's kind of hard to determine, where it's going to go, where it's not going to go. So that's what volatility is, and we want volatile stocks. In my opinion, I mean, some people don't like volatile stocks. Depends on how you are as a trader. Once again, liquidity. That's just basically how easily you can get in and out of the stock. You only want to, trade stocks that are very liquid, or trading a lot throughout the day. I don't like to trade stocks that are illiquid. There's no price movement, because if I buy a bunch of shares and I'm stuck with that stock and no one wants to buy it, what am I doing? It's wasting my time. Maybe if you're a long-term investor, you might want to do that, but I personally don't. So that's what liquidity is. Being able to get it out of stock as quickly as possible. Then there's risk to reward ratio. This is basically a comparison of, how much you're willing to lose and how much you're willing to risk to gain profit. You should know what a risk to reward ratio is, and you need to make up your own. So know that as a trader as well too. Being bullish and being bearish. Being bullish means you think the price is going to rise. Like I said, I'm a bull trader. I like seeing the stocks go up. But if I had to, I'll be a bearish trader. Bearish traders means that the stock price will fail. So you should know that. Being long means you're in a position that you're hoping the stock will rise. Being short means you're in a position where you hope the stock will fall. So you hear people say, I'll take a short position on that trade or that security. I took a long position on it. That's basically meaning that it'll go up or go down. Pretty easy. And then no bias, of course, is basically a cash position. You're not either. All right. Those are some pretty simple terms. All right. Market valuation and market cap. These things are important to a certain extent. You should just know what they are. You're not going to be looking at them every single day, but it does. It's something I pay attention to when I am about to trade a security, depending on the stock. But so it's something that you should know, I feel. So market valuation or market cap is basically the number of shares outstanding times the stock price. Pretty simple there. Authorized shares is basically the maximum number of shares that a company is allowed to issue to investors. Okay, and then shares outstanding, the total number of shares that are issued by the company. All right, and then restricted shares are shares that are bought privately or held by insiders. Sometimes you don't want to deal with a company that has too many of these shares, um, because it could, indicate certain things about the company. But it's something to keep in mind what the restricted shared amount is. Okay. The float or the public float, you hear that a lot. I pay attention to this quite often. Basically, this is just floating shares is just shares that aren't restricted. Publicly owned shares that are available for trading. I like looking at companies with low floats because if they have low floats, which means, if a lot of volume is going with it, a lot of liquidity is going with it, that means that stock is going to move. Now, whether it be up or be down, doesn't matter. I just like that fact that it, has a low float because I know it's going to move and I can plan accordingly. Then there's restricted shares. These are freely tradable shares on the market. I'm sorry, unrestricted shares are freely tradable shares on the market. There's secondary offerings. Now, a lot of times you'll hear this after hours, especially with companies. They'll offer secondary offerings for a company where basically they're selling insider shares to holders. The company doesn't receive any capital, but they do issue shares to raise money. So and that's when you'll see a price of the stock drop because of that. Then there's the private investment and the public equity. This is where they raise capital for a company. But pipe investors, they invest at discounted market price because they're on, they're private. They get in at a good deal. So you won't hear that too much, but that's what those are. So you should know what that is. And then share lockup is basically whenever a company like IPOs or merges, the people that own the shares are usually restricted from trading the shares for a certain time frame. It could be 6 months or 2 years or whatever is dictated by the company, but they're restricted from being able to trade those shares because of a lot of different reasons. It could be volatility, for whatever the SEC made that rule for, but just know what that is. Share lockup. Because I know recently, I forgot what the ticker was. One of the companies did either a merger or a stock split, one or the other, and people were wondering like why their shares weren't able to be traded on their broker, thinking that their broker was trying to screw them over. And it's like, no, your company's in a merger. You can't trade your shares for a certain time frame. No matter what the stock price changes to, you can't sell your shares. So that's what that is. Share lockup. Okay. Uh, all right. Different types of stocks. This is something you guys need to know as well. Oh, excuse me. We're getting through this, guys. We're getting through this. Different types of stocks. There's penny stocks, large cap stocks, mid cap stocks, small cap stocks, and micro cap stocks, nano cap stocks. Okay. Now, penny stocks are the cheap ones. Biggest risk, biggest reward, and chance to lose your money. I don't trade penny stocks. I started out trying to trade penny stocks. That's what got me attracted to the stock market. Well, one of the things that got me attracted to the market was the potential of how much you could make with that. Yeah, it's a lot of scams and things with that with penny stocks because they're not regulated. They don't have to buy by like SEC, regulation or anything like that. So I mean, it's up to you. If you like penny stocks, great, have fun with it. But that's what they are: biggest risk, biggest reward because they're penny stocks. Then there's large cap stocks like blue chip stocks, like Tesla, Apple, Microsoft, all those big name companies that you know of. Those are the big blue chip guys who have billions of shares available on market cap. Okay. Um, as opposed to like penny stocks where they have very, very low market cap. But those are the blue chip stocks. Big prices, big market cap. These are good. If you're a new trader, I usually recommend, start out trading with the blue chip stock, because they're bigger, they're larger. I mean, the prices, of course, is bigger too. And now brokers allow you to get fractional shares, but with it being a bigger stock and having more shares, it gives you more time to be able to predict a trend or how to be able to trade it. It's not moving too fast because it's a lot of movement that's required. These are usually traded by institutions and firms in AI software uh, when it comes to these stocks. So it's a good thing to get practice in if you're new. You get used to it with large cap stocks. Then there's mid cap stocks. These are valued between 1 billion and 10 billion in dollar value. And then there's small cap stocks, which is my favorite. They're between 250 million and 1 billion in valuation. And then micro cap stocks is also my second favorite as well too. It's companies that are valued between 250 million, which is generally most companies for the most part. So between micro caps and small caps, those are my favorite ones to trade um, throughout the day. So yeah, so those are the different types of stocks that are available. Different valuations, different price points for them. Next up, some more terms. ETF, exchange traded funds. This is a basket of securities, bonds, commodities, etc. As a stock trader, you're not really worried about ETFs unless you are. Um, then in that case, of course, you can do your diligence on that. But we here don't care about ETFs too much. They're pretty good for investment tools. ADRs, American Depository Receipts. This is just a way for Americans to purchase stocks overseas companies. That's what ADR is. You're not going to need to worry about that as a trader. Sectors. There are different areas of the economy that are related to a product or service. There's different types of sectors, guys. There's like the, EV sector. There's so many different sectors that are out there. Energy sector, healthcare sector, different sectors. Sometimes people just trade those sectors. You don't really need to worry about it too much on a particular stock that you're trading, but it's good to know about it because stocks themselves will follow the trend of their sectors sometimes, depending on the stock that you're trading for the most part. But good to know. Not going to be needed to know on a daily basis. IPO, initial public offering. Now, this is when a company lists on a stock exchange to raise capital from the public. You'll hear a lot of times, oh, this company's going to IPO. Basically, they're going public to be able to raise money and grow the company. That's what IPO is. Excuse me. Mergers and merger arbitrage. This is basically when two companies come together. It cuts costs and makes the company more efficient. Now, there's the opposite as well too, which is the reverse merger. Just a cheaper way for a company to IPO. Pretty simple to become its own company. And the spinoff is basically made a company made from the anchor of an already established company. So pretty simple there too. SPOCs, you'll hear a lot of people talk about this. SPOCs is kind of a new thing recently in the market. Basically, a special acquisition company. These companies are made specifically to be acquired by a bigger company that specializes in certain, a certain sector or a specialty area. Special acquisition company. Pretty easy. You hear a lot about SPOCs. I think ACIC is a good one that a lot of people are looking into right now. But yeah, SPOC companies. Stock splits. Now, those are used to increase the number of shares and lower the value of each stock. It's a good sign if you're bullish when a stock split happens. I actually just I bought some shares of Tesla and Apple when they did their stock split recently. One was like 1 for 5, and the other one was 1 for 4. Oh yeah, that's definitely a good profit, especially with the Tesla one because then it jumped up to like $800. So yeah, if you're a bullish trader, you like stock splits. On the opposite, there's reverse stock splits, where they consolidate a number of existing shares to make it more value. This is a bad sign if you're bullish because it's going to typically bring that stock price down. Now, diluted shares, this is when a company issues additional stock to reduce the ownership of the portion of the current shareholders. Um, Basically, it's when more shares are issued, and if you're a current owner, you don't really want to have diluted shares. A good example actually for you guys, if you ever watched a Social Network with Facebook, and Mark Zuckerberg's friend had diluted shares, and his like percentage of his ownership of the company went from like a lot to a little because they were issuing out more shares. That's what diluted shares is. This is why you need to read fine print of stuff. But yeah, that's a perfect example of what happens when you when you take on diluted shares or already own diluted shares or have diluted shares of a company. You don't want diluted shares if you're a long-term investor. But yeah, that's what that is. Pretty simple. Now, exchanges. There are different exchanges that different stocks list under. So these are different exchanges. There's the New York Stock Exchange. This is the most reputable and highly priced stocks that are there. There's the American Express. I'm sorry, American Express. There's the Amex, American Stock Exchange, and that's the small companies with large price and spreads, and they're not very liquid. But some stocks on there we do trade very every now and then. But that's what the Amex, the American Stock Exchange. Sorry guys, I used to work in the debt relief industry, and Amex was American Express all the time. That's why I'm saying that. But yeah, that's what that is. Now, NASDAQ, there's the most popular tech companies are in there. You'll see like, Facebook and all those guys are in there with NASDAQ. Then there's the NASDAQ small caps with companies that are, you know, from $1 to $10 in shares, and they're very liquid and volatile. Most of the stocks I trade are in the NASDAQ exchange anyways, between NASDAQ and NASDAQ small caps, mostly small caps, the ones I trade. Then there's the OTCBB, which is the over-the-counter bulletin board stocks. They're electronic. They're not Nasdaq companies. Some of them are liquid, some of them aren't. I know a couple people in the chat room trade the OTC companies, and those are usually only available on either full service brokers or brokers like Thinkorswim. They're not really that much available on Webull and Robinhood and things like that. The discount brokers, but you can make some money in OTC bulletin boards. I traded them sometimes. I don't do it often, but I definitely trade some of them when they look okay. And I know there's a lot of hype and stuff like that going around. One of the tickers. I might trade it. Then there's the pink sheets and the gray sheets, the smallest of the smallest companies. They're not very volatile and not very liquid. I don't touch these at all. Not worth my time. Not worth my headache. I tried it when I was penny stocking. Not worth it. But you might like it. Some traders are good at it. I don't know. Whatever's good for you. CBOE, that's the Chicago Stock Exchange. That's for trading options. I'm sorry, CBOE is for trading options. The CME is the Chicago Market Exchange. That's exchange for futures and currencies and options as well too. Pretty simple there. Penny stocks, guys. All right, these are usually stocks that are traded under $5. They're very speculative in nature. Again, I don't touch them. Tried them, didn't like it. Very manipulative. Not worth it for me. But that's what penny stocks are. Some people love these things because when they jump, they jump. So if it's worth the risk and reward to you, definitely, by all means have fun. But that's what they are. Stocks usually under $5 a share. Then there's the SEC compliance. These are where companies need to disclose their financials and legal matters, typically done quarterly and annually. In that video, I showed you guys about doing fundamental research. You'll see a lot of the filings there with SECs for companies to be able to, to check their compliance and see if it's something you want to be worth investing in long term. So that's good to know. You don't only have to deal with it every day, but good to know. Pump and dump. A pump and dump is basically promoting a stock to sell it at a higher price. So that's why you'll see a lot of times in these messaging boards, whether it be on Facebook, Reddit, some kind of chat forum, it doesn't matter. You'll see a lot of pump and dumps in there. People that are promoting the stock, oh, this stock is going to run 1,000%. Oh, blah, like they are hyping this stock up because they want you guys to go in there and buy because they're either holding the bag or they're getting paid by someone to promote this stock so that a bunch of people will go in there and blindly buy. And at the time that that stock shoots up, they're going to take their money and run. That's what a pump and dump is, especially when the company is a bunch of junk. But yeah, look out for those pump and dumps. Again, do your own due diligence. Do not take anybody's words when it comes to buying a stock, including mine. I mean, again, it's just my opinion, but yeah, do your own due diligence. Watch out for pump and dumps. They are everywhere in the stock market. Okay. Then there's blue chip stocks, like I said, we talked about bigger market caps. We already went over that. There's bonds. These are interests made by investors to represent a loan. Typically, you'll see like corporate bonds or government bonds. You don't have to worry about bonds. It's not going to, affect you as a day trader. You're not trading those, so you're fine. There's a foreign exchange, the forex, where people are trading like currencies and things like that. Then there's hedge funds. Hedge funds are, major fund companies that use leverage to invest in stock. Like for example, lately the good old Citron is a hedge fund. Um, those are big companies that use leverage to invest. Then there's mutual funds. These are investments of like higher price stocks. good for long-term and fundamental investors to have. And pension funds are large funds as well too that invest in all the above, mutual funds, hedge funds, all that stuff. That's what pension funds do. Again, IPOs, an initial public offering for a company. ICOs are initial coin offerings. This is dealing with like cryptocurrencies, kind of similar to what they would do with stocks, but just with a cryptocurrency. Pretty easy. All right, venture capital. You don't need to worry about this. In fact, most of the stuff here on this page you want to worry about. But venture capital, that's where funds that is used to invest in startup companies, that growth potential that companies see. Private equity is investing companies that are not listed on the public exchange. That's where private equity comes from. Investment banks are companies that help other companies issue stock with mergers, acquisitions, and private equity. That's the behind the scenes stuff. Institutional investors, the organizations that invest in large amounts. Again, behind the scenes stuff, you don't have to really worry about that. Secondary offering, like I mentioned before, companies sell stock, they don't receive any capital. Halts and circuit breakers. Okay, now this is something that you guys want to pay attention to. Halts and circuit breakers happen often when a stock becomes very volatile for one reason or another. They'll pause the trading on that particular stock. One of the most famous ones, of course, recently was with the GameStop thing, where Robinhood halted the stock. But this is a common practice. The SEC will have a stock be halted for one reason or another when it becomes very volatile, especially if it's something like breaking news or something that's going to make the stock run. It'll be halted up or halted down. This is a common practice. People thought this was something that was, an abnormal thing when it happened with GameStop, but it isn't. And us experienced traders knew that. So again, circuit breakers and halts, pausing of trading and security is common. All right. And again, share lockup is basically having, prices locked up. You can't trade them for a certain amount of time. Pretty easy. Indices, you don't really have to worry about, but these are the things that kind of predict the overall market and how it is. So there's the Wilshire 5000 that represents nearly all stocks on the New York Stock Exchange, the American Stock Exchange, and the Nasdaq 5000 companies that represent all that, the top companies. Then there's the Russell 2000. There's no pink sheets or OTC bulletin boards and junk like that on there. But these are 2,000 of the smallest publicly traded companies. Many small cap and penny stock companies are on there. The Russell 2000. The Dow Jones Industrial Average, 30 of the blue chip companies that are most actively traded, which kind of overall represents the entire stock market. So you'll see a lot of times that, like on CNBC and stuff like that, they'll say, "Oh, the Dow Jones, or the Dow has been down the last couple of days, or it's been up." And that's basically the overall market and the top 30 blue chip companies that's been traded often. S&P, Standard & Poor's 500. This is the index of the 500 largest companies in the U.S. Pretty easy there. Now, foreign markets is basically any markets outside of the company's own country. And it's pretty much what a foreign market is. Pretty simple there. NECs are important, but not too important because, again, certain stocks might follow the way the market moves. So if the Dow was down throughout the day, it's the reason why all the other stocks were trading down as well too. If the S&P was up, it's the same reason why your stock was probably up as well too, okay? Pretty simple. Then there's some more terms and then we are done. So these last little terms here, again, technical terms like technical indicators. These are basically tools that are used to help you illustrate various aspects of the price of underlying stock. There's the example, the MACD and the SMA. The MACD, the moving average convergence divergence, and then the simple moving averages are some technical indicators that you can use to be able to, look at the aspect and price action of a stock. Now, oscillators are tools that are used to construct high and low bands between two extreme values of a security. All right. Now, there's things like the stochastics oscillator. There's RSI, and then there's ROC, the rate of change. RSI is the relative strength index. I use RSI quite a bit. So those are just other isolators that you can use to help you determine the values between entering and exiting a certain stock. Okay. Again, we'll go into more details on this later on in different videos, but just know that those are what oscillators and technical indicators are. And there's plenty more where that came from. These are not the only ones. Trust me, there's hundreds more, so many more indicators and isolators. But yeah, that's pretty much it. You'll hear those quite often as a technical trade, as a day trader as well too. Okay. And that is it, my friends. That is stock trading 101. Basic terms for you to know when it comes to trading stock. If you want more information on different terms, you can look at some of these links here. I'll put them in the group chat and the learning lounge for you guys too, to be able to look at different terminologies and different financial terms that might interest you. But other than that, hopefully you've got a lot of information from this. Go back through, read it again, read it again. If you need to read it again, read it again. And throughout the days, just kind of try to recognize each one of those terms to help you become a better trader. And yeah, take a look at that app I send you guys, and hopefully that'll help you as well too. Give you a little pop quiz on what certain things are. You'll see this stuff repeated over and over and over. So eventually you'll be drilling your head to where you know it like the back of your hand. But other than that, guys, thanks for paying attention, and look for more to come. I'll build out some more videos for you guys, and we'll go from there. All right, take care.